Welcome to the first quarter outlook summary and of course the current outlook. Most of you guys know me, so we don't have too many, I think, people on here that don't know Womack Investment Advisors and myself. But today we're going to talk about what's going on with the markets for the first quarter of this year, and then also uh, an outlook, but then also talk about the topic of the day, and that's all the turmoil from the tariffs and the trade tariffs that we're seeing in the markets. So let's take a look at the market performance. The first quarter, the markets were down. S&P around 4.5, NASDAQ around 10.5, the small caps 9.3. International stocks did fairly well. And for the first quarter of the year. Now, in the first week of April, last week, and we saw the markets down 13.9. This was through yesterday, April 7th. 19.2 on the NASDAQ, 19.2 on small caps, and international pretty much gave back all the returns and some for the year there, being down about 3.2%. And then commodities, let's take a look at what commodities have done. We've got the oil was up 2.4% for the first quarter, energy stocks 9.1, material stocks 2.2, silver up almost 18, and gold at 19%. Then we had the first week of April, the down 12.7 on the oil year to date, down 8.7 on energy stocks, and down material stocks 8.9%. Silver still hanging on to gains at 3.1 and gold at 13% still. So bond prices somewhat stagnant, but they had a pretty good return in the first quarter. You can see treasury prices, long-term treasury, corporate bonds up about 2%, and high yield bonds basically just above water for the first quarter. Since then, for year to date, through April 7th, yesterday, 3.1 on treasury bond prices, corporate bonds about 0.5%, and high yields, which are riskier type investments, bonds down 3.2%. So bond prices, remain a little bit under pressure. Feds have stopped raising rates, and so we'll see what happens. There's pretty much, if the economy continues to kind of struggle in the markets, they may end up lowering rates, which would help bond prices as well. When you look at the international markets, international was the first quarter of this year was really where it was at. Is the UK was even though it's given back 6.9%, it was year to date it's down only 1.44 through April 5th. France down year to date to 1.43. Germany still positive for now, and Shanghai is pretty much flat. After increasing, it is a little bit flat, and then we had Japan's down about 15%. So looking ahead, let's think about what we'll see maybe perhaps in the next quarter, meaning this quarter we're in. So I'm going to share a poll with you. And this is a poll that basically says, what do you think will end up in stocks for the second quarter from these current levels? Do you think we'll be A, up for the quarter, B, down for the quarter, C, about the same level, or D, you have no clue? So if you'd like to, I'll share the results. If you could go ahead and vote on this poll we have here. So we've got a few more that need to chime in here. And I'll let it go for another 10, 15 seconds. So keep in mind that we've come down over 20% from the highs of these markets. And it all depends on how things shake out, but there's a good possibility we could be up for this quarter. We definitely could use it. So here I'm going to share the results with you and end the poll. And as you can see, about Oh, there's
Nobody knows.
20%. You got thinks it's going to be up for the quarter, another 20% down, about the same level. And then I think there's one that says no clue. Well, nobody has no clue. We're all smart.
Including him.
Yeah.
All right.
So it'll be interesting to see what happens. I think everybody saw the results on that, so we'll move on. Okay. So now here's an interesting development. As of Friday, the market on April 4th, we turned negative, and everybody knows that our indicators that we follow are very important to us because it tunes out the noise. And anything below 50, excuse me, if it falls below 45, we are in what we call bear market territory. This is where the big trend turns from positive to negative. So whether or not we have, you see these little pink areas here, this is where historically the market has turned negative. So we saw it in January, excuse me, around 2000, and that was through 2003. Then we also had it in 2008. And there was a few smaller bear markets that lasted perhaps a few months to as much as 6 months. And we had one in 2022 that lasted about a year. So now we've hit 40, below 45, which indicates a bear market. And down below, you see the S&P returns here that during these pink or the red out periods is where the bear market, where you saw as much as 50% drops in the market from the previous highs. And then here we have the January 2022, or excuse me, the 2022 bear market. So we don't know how long this bear market will last. All we know that is when we get an indicator that goes negative, that tells us that more than likely we're going to be in for at least a short period to who knows how long. It could be a few months, it could be a few years. So our goal is to start reducing exposure to the market. Now, yesterday started out down day after Thursday and Friday of last week, major sell-offs. So what we do is try to capture when the markets are doing these rallies, we start to liquidate and raise capital strategically based upon the trends of that individual security or sector or exchange traded fund. And so we've already implemented that today when the market was much stronger. The market opened today at over 1,000 points on the Dow, and everything was up 3 to 4%. It's since now come down off those highs, but still up a little bit. So we have started liquidating and reducing exposure. So remember, our goal is to make money in bull markets, but try to be as much protected as we can from the major downturns. Bonds are still positive. This goes back to 2002, and it shows you that because interest rates have come down some, bonds are still positive right now. And so, depending upon what happens in the near term, we may be allocating some of our allocation to our models based upon the risk tolerance of each model going into some bonds. International stocks remain positive for now. That's even though the international markets have come down a bit right here, it's still above around the 50 level, which is still indicating bullish. If it drops below the 45, much as the US indicator line here, then that's when international stocks would turn negative. So the volatility index measures basically the fear of the market. So the VIX closed at 45 last Friday. That was a 109% increase versus the previous week, which was 25. So you see this move here. This is basically investors and traders putting on more short positions of the market or betting against the market, increasing the options trading level there to the fear index. So it went highest it's been in since of August of last year. So the VIX, it's basically calculated market pricing for options on the S&P. and it is basically a measure of expected volatility over the next 30 days. Now that could come down, as it is down this morning or this afternoon as we're speaking, but this is just one indicator that we look at as well. So the big talk of really the last month, but or so, but particularly last week, is the newly announced universal tariffs that were announced on April 2nd. This is supposed to raise around 1.5 trillion in revenue over the next decade, and this escalation comes in addition to the previously announced tariffs, which would raise 1.3 revenue. So over the next decade, if these tariffs were to stay into place, this would raise roughly about 2.9 trillion over the next decade. Of course, there's a lot of questions, and I'm not going to try to pretend to be a tariff expert. We're going to talk about some of the basics of tariffs today, and to kind of see where this could end up. So the new Trump tariffs break decades of relatively low trade barrier regime. Here's a chart that shows the U.S. New effective tariff rates are reaching levels not seen since before the Great Depression. In 1934, the United States passed what they call the Reciprocal Trade Agreements Act. It was a law that basically gave the administration of President Franklin D. Roosevelt the authority to reduce tariffs through bilateral trade agreements without congressional approval for each individual change. So let's talk a little bit about the negative impacts of the tariffs. Now I'm going to mute real quickly, just so we don't get interrupted. But and I can unmute once we get to the question times as well. All right, so negative impacts, what are they? Well, one is it could cause higher inflation and cost. Let's take an example. If I were going to go out and buy a gadget, let's call a lighter, say a nice lighter for, you could buy it from China, let's say a China-made lighter for $25. Okay, that out of that $25, about $5 of it stays with whoever's selling it over here. The other $15 goes to, let's say, China for producing the lighter. On the other hand, you have an American-made lighter at say $25. The China lighter costs $20. The U.S.-made lighter costs $25. So your higher cost in the U.S. product, all that 25 stays in America. But if there's trade imbalance, trade a tariff on that lighter or that product that goes up 25% or more, then that lighter now costs $30. Okay, so that $30, $5 of it stays here. Then the other part, of course, is part of the tariff that is charged on that lighter. The American-made lighter stays at 25. So the consumer is going to have a choice to make. Do I buy now with the tariffs on, do I buy the Chinese-made lighter or do I buy the American? Well, more than likely they'll buy American because it looks cheaper than buying the imported product. So it can cause higher inflation on those things which we import. Unfortunately, as a country, we import quite a bit. Import way much more than we do, let's say, Canada, Mexico, or China. And so in this case, it's going to force people to think about where they want to put their money in buying that, but it also could cause higher inflation in certain other products and things that we import. This could then possibly result in a recession, which, by the way, recessions are a normal part of our things that our economy. There's peaks and there's troughs. So it could cause recession. The jury is out on that at this point, but that could be one of the things that it negative impacts. Of course, we're already seeing global tensions um, in these trade tariffs, and we're already seeing countries either saying we're going to raise our tariffs, particularly China, or you see many countries coming to the table say, okay, let's negotiate a trade deal here. This could also create economic and, of course, market uncertainty, which we're seeing right now in the stock market, because it's a lot of unknowns in the markets at this time. Okay, so another basically, if you like avocados, then you may be an angry avocado lover. So things such as avocados, Modelo's, and other things like that could end up costing more. So it's going to change a lot of your buying habits. It's going to make you think more about buying American-made products, which we'll get into the inflationary. Is inflation going to be a problem and higher costs? Well, we saw inflation go up tremendously through February of 2023, and then inflation started coming down, and it's coming down even further. And now with lower energy cost and possibly lower interest rates on the 10-year Treasury, it's fell below 4% for the first time yesterday, and it had in a couple of years. And so if interest rates come down, it helps on mortgage rates. It helps on consumer borrowing, those type of things. So we'll see if inflation starts to peak up, but right now the inflation has been kind of trending a little bit lower. So let's talk about the potential benefits of the tariffs. So there's a lot of debate surrounding the efficiency of the tariffs. Is it essential? And it's also, I think it's essential to recognize the benefits that tariffs can offer to the American citizens and businesses. One of those is strengthening domestic industries. And as I gave you that example of the Chinese products versus the American products purchasing American, it's going to cause, but when more people purchase American products, it's going to cause those industries to grow and hire more employees to make the same gadgets and products that they're making today, which would create job creation and possibly economic growth as a result. Enhancing national security is another one, with all the illegal legal immigration from the various countries, but also the illegal drugs coming across the borders. This is to enhance security of our borders and our nation. Reducing trade deficits. So we run a huge deficit against these other countries. They they export to us where we import from these various countries. And like, for example, Canada and Mexico is well over 20% of their GDP. And so it's by putting these tariffs on, it's going to help reduce these trade deficits that we're having between these other countries. Encouraging fair trade practices is going to force countries to come to the table to try to work out fair trade deals with the U.S., which, as I mentioned earlier, this could create also substantial government revenues. And these are basically reciprocal trades, tariffs that are being put on. It's kind of crazy, over the last 40 years, whether it's Republican or Democrat, both sides of the table have really put China as a most favored nation, and we've exported just about everything that we do. Not everything, but a lot of things that we do. We depend upon these other countries, and so hopefully we'll come to the table once a lot of this noise dissipates and the dust settles, that we can come and have some decent fair trade practices. In the meantime, we also will create more government revenue, which can help support social programs and other programs in the budget of the U.S., which if we see economic growth and domestic industries grow, and there's already trillions of dollars committed to these various companies coming here to create more products in the United States, moving factories, that even American companies that are moving factories back to the US. And then also this could spark more of a promoting technological innovations, whether it's, AI, cloud centers, or, other technology areas that we can improve in our nation. And then strengthen international negotiation positions. Countries need us. We are the world's largest consumers of goods and products, and countries need us to keep buying their stuff. And so this will help strengthen international negotiation and positions. Okay, so buy American, made in the USA, and that's going to make American products look better, and it'll increase hopefully our demand for that. So let's take another poll, maybe at least this one here. Poll number 2, if I can do so here. Well, here we go. Poll number 2. Here we go. What's your opinion of the Trump trade tariffs? 1, A, will they hurt economic growth? B, will they help economic growth? C, there should be more positives than negatives? Or D, I'll have to wait and see. So if you could vote those, I'll release those, share the results here in just a few seconds. So I think it's probably going to be one of those deals where we're going to have to wait and see. But based upon how we consume more than any other nation, and they are more dependent upon us, it just seems like a basic notion that if those should work to our favor, even if they're just the same amount of tariffs that these other countries are putting on the U.S. So I'm going to end the poll and share the result. So you can see it's about not quite half and half, but it's 3 out of 5 says that will help economic growth, and 2 out of 5 said we'll just have to wait and see. Okay, so moving right along here. So I mentioned gold, how gold has outperformed the markets really over the last 5 years. Most of you who know, familiar with our investment strategy, we're allocating 10 to 20% of our clients' money in precious metals, whether it's silver or gold. This can help against inflation, but also against market turmoil. We've seen gold hit $3,100 an ounce recently, this last week, and that's the highest it's ever been. Now, central banks are the third largest category of demand for gold, right after jewelry and investment sectors, and those account for 23% of global consumption. So usually, their prices are sensitive. They buy on dips and are curbing purchases when prices rise, but spot gold hit its latest record of $33,167 a troy ounce on Thursday, for a gain of roughly 19% since the start of 2025, and a hefty 71% rise since the end of 2022. So in the final quarter of 2024, when Trump won the U.S. election, central bank purchases basically accelerated 54% year on year to 333 tons, according to the World Gold Council. Now, central banks for many years have been purchasing record amounts of gold, and this year is going to be projected to be another record. And why is that? Well, for so long, many of our countries and central banks have been printing basically money without backed by anything. And so this whole thing of in my opinion, is all this trade tariffs and trying to create more fair trade balance. It's the end of the old regime, and it's in multiple areas you see it. One is where these central banks around the world are moving to back their currencies with something, and gold is the world reserve currency. It has been for thousands of years. It's a precious metal. I call it God's money because it's go back as far as 6,000 years, and you see where gold has played a role in the economies and society of the world. And when you look at the US dollar, it's a struggle of late here. As you see the blue, it's come down. Gold and the dollar tend to have an inverse relationship over a longer period of time. So as this chart depicts, you can see where the dollar goes down, and historically, and gold can rise. Now it's not exact the whole time. We've seen actually the dollar rise over the last year or so, and just to recently pull back, and gold also continues to rise. So gold, like I said, has hit all-time highs, breaking the 3,000 mark per ounce. Many are calling for 3,500 or more per ounce before the end of this year. And I'll talk a little bit about more in gold and silver. So one of the things that we're seeing is Basel III, which really takes effect this July. And it's a banking regulation designed to decrease the damage done to the economy by banks that take on too much risk. So it was introduced following the 2008 global financial crisis, and it's to improve the bank's ability to handle any shocks from the financial stress, and to strengthen their transparency and their disclosure. So the regulation reclassifies physical allocated gold as a tier 1 asset, as the safest tier. So when I say physical allocated gold, what I mean by that is this not paper gold. The problem we've seen is that all these huge gold vaults around the world have loaned out their gold, paper gold. They've loaned it out in sometimes multiple loans per ounce of gold. And so while it basically is going to, the Basel III will say, we're going to categorize paper gold as unallocated, as a tier 3, which is riskier than the tier 1. So tier 1 is the safest. So in addition, it obliges financial institutions to hold capital buffers of 85%. So basically, it's going to force more of the central banks to continue to buy gold. As it stands now, the regulation should take effect in July 1, followed by a 3-year phase-in to give banks time to transition to the new rules. So a lot of these smaller central banks around the world, the emerging countries, don't have roughly, some reports, as 10% of gold. So they need to increase their gold positions substantially. So this is going to continue to be a tailwind for sound money and for securing up these central banks and currencies. So even though gold may be a little volatile, we think the trend will probably continue to be up, and we could see continued record gold prices even this year. Now I want to talk a little bit about silver. Let's talk about the silver lining of all this. One is it could be the surprise winner during this economic downturn, let's say, or market downturn. So we're going to pivot for a second, because while everything else is crashing, some investors are eyeing silver like it's the latest life raft on the Titanic. Global silver demand is expected to remain broadly stable in 2025. The demands continue to be stable, if not up, at 1.2 billion ounces. But the global silver supply is forecasted to grow by 3% to an 11-year. In other words, the demand is forecasted to grow by 3% to 11-year high of, I got that mixed up. So we're 1.2 billion ounces of global demand, 1.2, but the actual supply is only 1 billion. So we're short over 200 million ounces of silver every year, particularly this year. So it's huge demand for silver. We're still seeing where, gold has outperformed silver, but there are times when silver makes its move like it did in 2000, 6 and 7 up through 2011. We saw silver go up substantially much higher than gold. So historically, silver is still off the highs of almost $50 an ounce, whereas gold has made new highs. So silver has the potential to make a significant move. It broke $35 per ounce recently, the highest in over 2 years. So look for silver to potentially increase over the coming months, possibly reaching old-time highs of $49 to $50. And many analysts predicting higher silver prices, even higher than that. So we still like silver, and we still plan to continue to hold silver and buy on the dips. So in summary, the stock market has turned to bearish trend. We're starting to pull back on our models to get more conservative and to be more protective. If you have a 401k or stuff that you don't have here with us to manage, let me know. We can talk through the 401k and see if there's some changes you need to be making in your 401k, because we don't know how long this bear trend will last. We can expect a relief rally at some point, which we did this morning. So we're not doing a full sweep of going to cash, but we're starting to liquidate certain positions. And as we see the opportunity, we'll continue to until the trend turns to bullish. Also, the tariffs will impose some short-term pain, possible recession, and market volatility. It depends really on what kind of trade deals we get. I had a client ask me yesterday, how long can we see something where we see a reversal? Well, I go back to if we just get a handful of these countries that are major trading partners come to the table and make a trade deal that's fair and that's accepted, you're going to see the market, particularly if it's with China. And right now, they're pushing back a little bit, but this is all really a bunch of noise. And this is an act that has to be played out in order to make these deals. But this ultimately could lead to more economic security, and we could see the markets significantly improve months down the road. Lower interest rates and lower energy prices will help the economy in the meantime. This just could keep us from possibly going into a recessionary period. But like I said, recessionary is not all bad. In fact, most of the time when the media announces that we're in a recession, we've already been in one for 6 months or more. So it's just part of the game, the economic wheelhouse that we're in. The other thing I would say is turn down the noise. I mean, we can get hyped up and just stressed out. I know that this weekend with Thursday and Friday, the terrible markets, I was planning for my presentation, and most of you know I have a grandson. He's 7. He loves coming out to my place, and we just in the country. And I thought, I don't need that this weekend. I need to focus on, that. But you know what? I just turned out a lot of the noise, and because it can create stress, right? Especially if you're retired and you're dependent upon your assets, it can create a lot of stress. But I was so glad to have him out this weekend, and we spent some quality time, and I did get a chance to read and do some research and things, but just to turn out the noise, enjoy life, but we stick to a disciplined game plan. And that's the key here. We're not going to let our emotions rule the day, but we do have a plan, and we plan to get, as I said, more conservative here in the next bit to help reduce any more downward exposure. One of those things that I'd like to share with you is, we've been helping our clients develop trust and estate plans for many years. And we've settled out a lot of estates. Some of you already have a trust or a estate plan, but we're proud to help you and your family create an estate plan. And we've developed a new partnership with a company called Estately, and they have attorneys on staff, but it's really a turnkey, a way to get a trust-based plan into place. And these documents would include revocable trust, includes a pour-over will in case anything's left outside of the trust upon death or a disability, financial power of attorneys to help you continue to go on and let someone manage your estate if you're incapacitated, healthcare directives, which also is a last will, living will, excuse me, and then uh, medical directions on having someone making medical decisions for you in the event that you can't. We also include a quitclaim deed, additional cost of $50 to do additional quitclaim deed, and that can be filed with the county in which you live. But this is all starting at $9.95, pretty much for this whole thing right here. And depending on the complexity, if you've got a lot of oil and gas interest or other real estate, it could be a little bit higher. But if you were to go to an attorney, which we still use a lot of attorneys locally here, but it would cost you perhaps double that. So we want to make sure our clients have the ability to get a trust-based plan done at a reasonable cost, and we help you go through that whole process. Here's a little barcode here. If you wanted to scan that on your phone, take a picture of that, open it up a website, and you can begin your estate planning, and we'll help collaborate with you to make sure everything's done and done appropriately. So, questions. What are your biggest concerns about your portfolio and financial planning? Any concerns you have? There's a survey. When I close this webinar out, there'll be a survey that pops up after this webinar, and we'll follow up with you and help you be prepared and perhaps answer any questions you have. So if there are anybody that'd like to be able to chat and ask a question, you can raise your hand. You can, but I'd be glad to see if there's questions. Hopefully, I can answer them. Any questions you guys like to offer? Okay, I'm going to give you guys a few minutes for comments and a question. And I want to thank you again for attending today. I'll keep this session up for a bit and send it out to those who didn't get a chance to go live with us here. So the chat should still be available. If you'd like to chat and ask a question, that'd be great. Okay, well, I think B Shack had a question. I'd be glad to hang on there for a little bit longer. B Shack. Oh, we got some questions here. So it says, glad that you were pulling back based on our data. This is very important to protect our money. The question I've heard, several countries have contacted the president to negotiate our tariffs. That's good news. Yeah. Supposedly there was 50, now there's possibly 70. So like I said, I think since these countries really can't win a trade war with us, I guess if these countries don't want to make a deal, that's when things could get a little tougher, as far as inflation and supply chains, that type of thing. But it'll also longer term improve our domestic industry. But in the meantime, it could get a little tough if these countries aren't willing to come to the table. Um, and I think they can't win a trade war with us. I mean, we import so much from these countries and they depend upon that. Like I said, over 20% for Canada and over 20% for Mexico, and it's up there for China as well. Um, and so these countries really cannot win a trade war. That's why, because we consume so much of the world's goods. That's it, period. It's going to be hard for them to win a trade war. Now, will there be some short-term pain if we don't come to some trade agreements? Yeah, but I think what we'll hear in the coming days is more trade deals being done favorable to our domestic industry and our economy. So I want to thank you guys. Let's see here. Do you recommend some of your clients move or transfer money into a Roth? That's a great question. In fact, that's one of the slides I didn't get in here. But so what that question is if your IRA account, when you convert it to a Roth IRA to get it into a tax-free environment, you have to pay the taxes on the amount you convert. But if those securities in those IRAs are down, then if you converted that Roth IRA into a Roth, there's less tax consequences, say there were in, several months or several weeks ago. And so instead of account being 100,000, if you're down, 15% and it's 85,000 versus 100,000 being taxed if you were to convert that Roth. So when prices are down, it is a good time to consider possibly converting all or part. Even you can do a partial rollover or a conversion from a traditional IRA to a Roth. And the reason you want to do that is if you say, I don't need that income from that IRA for some years, and I want to get it into a tax-free environment. I'm going to go ahead and take my hit up front, put it into a tax-free environment. It grows tax-free. And if you wait 5 years, you can pull out all your interest tax-free from the Roth, all the growth, and not pay any taxes on the growth on a Roth IRA. Typically, you want to keep it there long-term to be able to make up for the taxes that you had to pay in the conversion. But it's a good question. All right, I don't see any other questions at this time. Look forward to hearing from you, and thanks again for attending. And there'll be a survey right afterwards, and appreciate everybody. So thank you so much.